Climate change will require $100 trillion. You keep hearing those numbers. But who decides where that massive amount of money actually goes and who benefits from it? From the first sentence, you feel the scope. And from the next, you begin to suspect there is more than rescue at work. The experts compile estimates that range between $100 and $150 trillion for the transition. Those figures cover power grids, transport, buildings, agriculture, and more. And that scale changes the rules of global finance forever. When you hear 100 trillion, you should imagine entire national budgets being redirected and new financial markets being created. Institutions like the UN, the World Bank, and the IEA all point toward this same colossal need for capital. Those institutions summarize technical gaps and prescribe funding mechanisms, and their reports become roadmaps for governments and private finance. When you accept their arithmetic, you also accept the frameworks and the actors they recommend to manage that capital. But here is where it gets interesting. The need for trillions opens an opportunity space for finance to expand into climate policy. Private markets, public banks, and multilateral lenders begin to rebrand themselves around sustainability, and that rebranding changes incentives and power in the economy. You should start asking, who gets to set the rules when money this large flows through new channels? One of the earliest mechanisms to channel capital is ESG investing, which claims to reorient capital toward environmental, social, and governance goals. ESG becomes a set of metrics and indices that steer trillions of dollars, and once interpretation matters the market becomes political. You need to understand that ESG is not purely technical. It is a tool for deciding winners and losers across the economy. Another set of tools includes carbon credits, cap-and-trade systems, and voluntary offsets that create tradable permits tied to emissions reductions. Those markets promise efficiency by letting companies buy and sell the right to pollute less. And at scale, they create new asset classes traded by brokers and exchanges. When you follow the money in carbon markets, you find intermediaries and complex valuation models, rather than simple reductions in emissions. Green bonds are another pillar of the climate finance revolution, and they claim to finance environmental projects with dedicated proceeds. Governments and corporations issue green bonds that attract investors who want both returns and impact, and the market grows into the hundreds of billions annually. Yet the question you must ask is who verifies the green label, and how lenient those labels actually are in practice. What happens next will shock you. Large asset managers begin to integrate ESG and climate into passive index funds and active strategies alike. Firms like BlackRock, Vanguard, and State Street control trillions of dollars of assets and now influence corporate behavior across industries. When you realize that a handful of firms can push ESG criteria on companies globally, you begin to understand how capital allocation can be centralized. BlackRock in particular starts to appear repeatedly because of its scale and advisory roles to governments and regulators. The company manages trillions in assets across ETFs and active funds, and its executives advise central banks and policymakers. You must consider the implications when the largest asset managers sit at the intersection of public policy, private finance, and climate strategy. Central banks begin to incorporate climate into their mandates and risk frameworks, and that marks a major shift in monetary policy. Groups like the Network for Greening the Financial System push scenario analysis and climate stress tests into central banking. When the Fed, the ECB, and the BOE apply climate lenses to their balance sheet operations, you should realize monetary policy is changing shape around climate priorities. The Fed, the ECB, and the Bank of England have all started to explore climate risks within financial stability frameworks, and their actions ripple across markets. They publish guidance, convene working groups, and incorporate climate scenarios into supervisory practices, and markets pay attention to those signals. If you follow these signals, you see that capital cost and access to liquidity can be influenced by climate alignment judgments. But here is the crucial part. When central banks add climate to their toolkit, they alter risk pricing and credit allocation in ways that were once purely market-driven. Tools like collateral eligibility, repo operations, and bond buying programs can favor green instruments and penalize fossil dependent assets. You must understand that these are blunt levers which, in skilled hands, reroute capital at national and international scales. Carbon credits and emissions trading schemes also become sources of new rents and profits, and they build entire industries of verification, brokerage, and auditing. A market-based solution turns into a market for control when verification standards and registries concentrate power among a few providers. You need to see how the complexity of these instruments creates informational advantages for specialized firms. Where does the money actually flow, and who benefits from this new climate economy? Large asset managers, specialized climate funds, and green technology firms receive the majority of institutional allocations early on. You should notice that incumbents and insiders positioned to manage capital extract fees and control investment narratives as trillions are directed their way. Private equity and venture capital create another channel for wealth concentration as startups with climate-friendly branding attract huge valuations. These funds promise high returns and impact, and limited partners syndicate massive pools of capital into new technologies. When you learn how valuations and exit strategies align with policy incentives, you begin to understand the incentives driving corporate behavior. International institutions like the UN and forums like the World Economic Forum push climate finance frameworks that aim for global coordination and standard setting. Their convening power shapes narratives, and private-public partnerships become the vehicle for global investment strategies. You must ask who is represented in those rooms and whose interests are prioritized when global standards are set. Developing nations are promised $100 billion annually as climate finance, and that promise circulates in diplomatic dialogue and headline statements. Those commitments look substantial, but they often arrive as loans, conditional programs, or project-specific financing rather than simple grants. When you consider the structure of that aid, you must also consider the long-term fiscal implications for borrower nations. What happened next will shock you. Many developing countries begin to access climate finance through loans that increase external debt burdens. Conditionality in project design sometimes favor imports of technology and consultants from wealthy countries, and local value creation can be limited. If you follow the loan contracts, you will frequently find that debt dependency grows alongside the promise of green transition. At the same time, banks and financial institutions increasingly de-risk their portfolios by avoiding fossil fuel financing, which leads to debanking of certain energy projects. The withdrawal of capital from traditional energy sectors can accelerate transitions, but also create supply constraints and geopolitical vulnerabilities. You must consider the balance between incentivizing cleaner energy and maintaining reliable energy supplies for economies. The energy crisis you sometimes see in news headlines can be linked to rapid shifts in capital allocation and policy-driven retirements of existing capacity. If new renewable capacity and grids are not built quickly enough, supply shortages and price volatility can occur. You need to connect the dots between finance-driven transitions and the physical realities of energy systems. Carbon trading schemes also create new speculative markets where prices can spike or collapse, and that volatility attracts sophisticated trading firms. These markets are not purely environmental tools anymore. They become venues for profit, arbitrage, and political influence. You should be wary when environmental integrity is sometimes secondary to market liquidity and profit motives. Who decides what is green becomes the central question because label control equals capital control in practice. Certification bodies, rating agencies, and auditors wield outsized influence when they define eligibility and impact. You must understand that the arbiters of green definitions can shape entire industries through their standards and endorsements. Power shifts from democratic processes toward technocratic and financial authorities when unelected entities begin to steer capital at scale. Central banks, global forums, and private asset managers operate through expert networks and corporate governance rather than voter mandates. You should ask whether allocating trillions through such channels is a form of governance that lacks public accountability. The consequences are profound because capital allocation determines which industries survive and which communities bear costs of transition. Regions dependent on fossil employment can face economic decline, while new winners capture intellectual property and high-margin services. You are watching an economic reordering that rewards those who control finance, data, and certification systems. There is, of course, a legitimate case that massive investment is necessary to avoid catastrophic climate outcomes and to improve human well-being. The technical and moral arguments for rapid decarbonization remain powerful and compelling, and many interventions will deliver both climate benefits and economic opportunities. Yet you should remain open to the critique that some climate finance channels privilege control and profit over broad-based benefit. When you add up the flow of funds, the actors involved, and the institutional architectures being created, you can see the contours of what might become the largest wealth transfer in modern history. Calls for $100 to $150 trillion create both a humanitarian imperative and a political instrument for reshaping economies. You must decide whether you view this as essential correction or as a transfer of power disguised as rescue. The final question you are left with is who gets to decide the rules when climate action is framed as unavoidable and urgent. If governance is concentrated in a relatively small set of institutions and firms, democratic accountability risks being sidelined in favor of technocratic expediency. You should demand transparency, inclusive decision-making, and safeguards so that climate finance helps people rather than concentrating power. In the end, the debate is not about whether climate action is necessary. It is about who should steer the transformation and by what rules. You can believe in urgent decarbonization while also questioning the concentration of decision making in global finance and technocratic bodies. The philosophical twist is clear. The language of saving the planet can also justify consolidating economic control, and you have a responsibility to interrogate both outcomes. If this investigation gave you a new perspective on climate finance and the forces shaping where your money goes, subscribe for more deep dives into economics and power. Watch other videos that trace money, influence, and policy across modern history so you can better understand the stakes. If you want to keep exploring these questions, hit subscribe and join a community asking hard questions about who decides the future.